The early 2000s were years of optimism in America. The economy had recovered from the dot-com bust, interest rates were low, and homeownership was celebrated as the cornerstone of the American dream. Banks encouraged families to buy homes, mortgage brokers lined up eager borrowers, and Wall Street transformed these loans into investment products that promised steady profits. But beneath the surface, the seeds of disaster were growing. Risky lending, excessive leverage, and blind faith in ever-rising home prices created one of the largest bubbles in financial history. When it burst in 2008, Wall Street nearly collapsed, the global economy plunged into recession, and governments were forced to take extraordinary measures to prevent complete meltdown. This is the story of the 2008 global financial crisis, the worst since the Great Depression. The roots of the crisis lie in America's housing boom. After the 2001 recession, the Federal Reserve cut interest rates to stimulate growth. Mortgages became cheap, and millions of Americans rushed to buy homes. Housing prices began to soar. From 1997 to 2006, the average U.S. home nearly doubled in value. Real estate was seen as a one-way bet, and flipping houses became a national pastime. Banks and mortgage lenders, eager to profit, began relaxing standards. No income, no job, no asset loans, called ninja loans, were handed out to borrowers who might not afford them. Adjustable-rate mortgages offered low teaser rates that reset to much higher payments later. Subprime lending exploded. Lenders earned fees by originating loans, then quickly sold them off, so they had little incentive to worry about defaults. Wall Street, meanwhile, saw opportunity. Investment banks bundled thousands of mortgages into securities called mortgage-backed securities, MBS. These were sold to investors around the world as safe, income-producing assets. Even riskier slices of these bundles, called collateralized debt obligations, CDOs, were given top credit ratings by agencies like Moody's and S&P. Pension funds, insurance companies, and global banks loaded up on them, believing they were virtually risk-free. At the heart of the problem was leverage. Investment banks borrowed heavily to amplify returns, some at ratios of 30-1. This meant even a small decline in asset values could wipe them out. Credit default swaps, essentially insurance contracts on bonds, added even more complexity and risk to the system. AIG, one of the world's largest insurers, sold trillions of dollars in these swaps, convinced that housing could never collapse everywhere at once. By 2006, cracks were appearing. Housing prices began to slow, then decline. Borrowers with adjustable-rate mortgages found themselves unable to pay when rates reset. Foreclosures surged. The supposedly safe mortgage-backed securities began to lose value. Banks and investors holding them faced mounting losses. The crisis intensified in 2007 when two Bear Stearns hedge funds heavily invested in mortgage securities collapsed. By early 2008, Wall Street was in turmoil. In March, Bear Stearns itself was on the brink of bankruptcy, only to be rescued in a fire sale to J.P. Morgan Chase, backed by the Federal Reserve. Confidence was shaken, but few realized how much worse things would get. The breaking point came in September 2008. Lehman Brothers, a storied investment bank with over 150 years of history, collapsed after failing to find a buyer or government bailout. The bankruptcy sent shockwaves through the global system. Financial institutions stopped trusting each other, freezing credit markets. Companies could no longer borrow to fund daily operations. Stock markets around the world plunged. At the same time, AIG was imploding under the weight of its credit default swap obligations. The U.S. government stepped in with an $85 billion bailout to prevent its collapse from dragging down the entire financial system. Other institutions, like Merrill Lynch, were sold under duress, while Washington Mutual became the largest bank failure in U.S. history. Panic gripped the public. Ordinary Americans watched retirement accounts shrink, home values plummet, and jobs disappear. Unemployment soared as businesses cut back. By early 2009, over 8 million jobs had been lost, and trillions in household wealth had vanished. Governments and central banks launched extraordinary measures to stabilize the system. In the U.S., Congress passed the Troubled Asset Relief Program, TARP, committing $700 billion to shore up banks. The Federal Reserve slashed interest rates to near zero and launched unprecedented programs to inject liquidity into markets. Around the world, similar emergency steps were taken. The crisis forced a reckoning on Wall Street. Once celebrated financial engineering was now viewed as reckless gambling. Public outrage boiled over at the sight of executives receiving bonuses while taxpayers funded bailouts. Protest movements like Occupy Wall Street later emerged, channeling anger at inequality and corporate excess. In the aftermath, sweeping reforms were introduced. The Dodd-Frank Act of 2010 aimed to reduce systemic risk by increasing oversight of banks, creating the Consumer Financial Protection Bureau and imposing stricter capital requirements. Derivatives markets were brought under tighter regulation, and "too big to fail" became a phrase etched into financial consciousness. For investors, the crisis was a stark reminder of the dangers of leverage, complexity, and herd behavior. Diversification and risk management took on new urgency. For policymakers, it underscored the need for vigilance to prevent bubbles from spiraling into global disasters. Globally, the crisis reshaped geopolitics. China, less affected, emerged stronger, while Europe faced its own sovereign debt crises. Confidence in Western financial leadership was shaken, and debates over capitalism's sustainability intensified. The 2008 crisis also left lasting scars on a generation. Many young people entered the workforce in the shadow of recession, facing limited opportunities and stagnant wages. Home ownership rates fell, and distrust of financial institutions deepened. Yet, from the wreckage, recovery eventually came. By the mid-2010s, stock markets rebounded, banks rebuilt balance sheets, and economies stabilized. But the memory of 2008 lingers, a reminder that even the most sophisticated financial system can collapse when greed, complacency, and complexity collide. For Wall Street, 2008 was its darkest modern hour. The images of Lehman's bankers carrying boxes out of headquarters, Congress scrambling to avert collapse, and stock tickers bleeding red remain symbols of the fragility of finance. The crisis proved that markets are not invincible, and that when Wall Street stumbles, the world follows.